The 2026 Horizon, mapping the S&P 500's potential path. As investors navigate the economic crosscurrents of the mid-2020s, setting a strategic gaze toward the year 2026 has become a critical exercise. The S&P 500, the definitive barometer of U.S. large-cap equities, stands at a fascinating inflection point, shaped by technological disruption, evolving monetary policy, and shifting geopolitical realities. Forecasting its precise level 2 years out is an exercise in probabilistic thinking, not prophecy. Yet, by analyzing fundamental drivers and consensus views, we can map a range of credible targets and the scenarios that could bring them to life. The Consensus Foundation, a baseline for growth. As of late 2024, early 2025, the forward-looking analyst community, synthesizing thousands of individual company estimates, typically projects a baseline for the S&P 500 in 2026 in the range of **6,000 to 6,300 **. This target is not pulled from thin air, it's built on a foundation of moderate earnings growth and stable valuations. 1. Earnings growth, the core engine. After the volatility of the early 2020s, corporate earnings are expected to enter a phase of normalized, mid-single-digit annual growth. For the S&P 500 to reach, say, 6,200 by the end of 2026, it would require a compounded annual earnings growth rate of approximately 5 to 7% from 2024 levels, assuming a steady price-to-earnings PE multiple. This growth is predicated on a soft landing economic scenario, where inflation settles near the Federal Reserve's 2% target without a severe recession. 2. Valuation multiple, the PE, the sentiment amplifier. The market's PE ratio reflects investor confidence and the perceived risk of future cash flows. If interest rates have peaked and begin a gradual decline, as many expect, it could support a stable or slightly expanding PE multiple historically in the 18 to 20x range for forward earnings. This, multiple stability, is a key pillar of the baseline target. 3 scenarios for 2026, defining the range. The baseline is just the center line. The true picture is defined by a spectrum of potential outcomes. ******1. The bull case, the productivity boom, scenario target, 6,800 7,200 plus. This scenario envisions a powerful virtuous cycle. Artificial intelligence transitions from hype to tangible, widespread productivity gains across sectors, boosting corporate margins and justifying higher valuations. The Federal Reserve executes a smooth easing cycle, and consumer resilience continues unabated. Crucially, this scenario requires a re-acceleration of earnings growth into the high single or low double digits. If generative AI tools begin to significantly impact software development, drug discovery, and operational efficiency, earnings estimates for 2026 could be revised sharply upward. In this world, APE multiple expanding toward 21 to 22x on elevated growth expectations is plausible, launching the index toward or beyond the 7,000 mark. *2. The bear case, the stagflation or deep recession, scenario target, 4,800 5,300. The primary risk to the bullish outlook is an economic downturn. If the lagged effects of tight monetary policy finally trigger a meaningful recession, corporate earnings would contract, not grow. Alternatively, if inflation proves stubbornly persistent, forcing the Fed to maintain restrictive rates for longer, higher for longer, morphing into higher forever, it would pressure both earnings and valuations. A recession could see earnings drop 10 to 15%, while a stagflationary environment could compress the PE multiple to 16x or below. This double whammy of lower earnings and a lower multiple could see the index retest levels from the prior correction cycle. *3. The muddle-through case, the sideways grind, scenario target, 5,800 6,100. Often the most overlooked, this scenario involves the index churning within a range. Growth is anemic but positive, inflation is sticky but not accelerating, and rates remain elevated but not crushing. Earnings grow at a meager 2–3% annually, while the PE multiple contracts slightly due to persistent uncertainty, perhaps from geopolitical tensions or regulatory pressures on mega-cap tech. The market makes little net progress for 2 years as time is needed to digest previous gains and await a new catalyst. Critical variables to monitor. Your investment decisions for 2026 should be guided by these key indicators. The Fed and interest rates. The path of the 10-year Treasury yield is the primary competitor to equities. A sustained move lower supports higher equity valuations. A surge back above 4.5% would create stiff headwinds. Earnings revisions. Watch for analysts to upgrade or downgrade their 2026 earnings forecasts. The direction of these revisions will be the most powerful signal for the eventual target. The Magnificent Seven and concentration risk. Can the rally broaden? The index's health in 2026 may depend on whether other sectors, like industrials, financials, or healthcare, begin to contribute more meaningfully to growth, reducing vulnerability to a stumble in a few tech titans. Geopolitical stability. Events affecting global trade, energy prices, or technological collaboration can swiftly alter the growth trajectory. Strategic implications for the long-term investor. For an investor with a 15-year horizon, 2026 is a single waypoint, not a destination. Obsessing over a precise target is less important than adhering to sound principles. 1. Embrace diversification. The wide range of potential outcomes underscores why a portfolio diversified across asset classes, and within equities, across sectors and market capitalizations remains essential. 2. Focus on quality. In an uncertain macro environment, companies with strong balance sheets, durable competitive advantages, and consistent free cash flow generation are best positioned to navigate any scenario. 3. Use volatility. The path to 2026 will not be linear. Periods of fear-bear scenario may present opportunities to acquire high-quality assets at a discount to their intrinsic value. Conclusion. The navigator's mindset. The S&P 500 target for 2026 is not a fixed number, but a dynamic range shaped by economic data, corporate execution, and global events. The baseline of **6200* provides a useful reference, but the bandwidth of possibility stretches from the **5000s in a downturn to the 7000s in a boom. The wise investor in 2025 is less a forecaster and more a navigator, equipped with a map of these scenarios, a disciplined process, and the flexibility to adjust their sails as the winds of change inevitably blow. The goal is not to predict the ocean's state in 2 years, but to ensure your vessel is seaworthy for whatever conditions arise.